Most people assume that when the price of gold goes up, gold mining stocks should rise right alongside it. It feels logical to think that when gold becomes more valuable, the companies that dig it out of the ground should automatically earn more money. But that's not always how it works, and this misunderstanding leads many investors to make decisions that don't turn out the way they expect. Today, I'm debunking the myth that gold mining stocks automatically follow gold prices, and I'll show you what actually drives their performance. On the surface, the idea seems simple. If gold sells for $4,000 an ounce instead of $3,500, then mining companies should be making far more profit. But here's the crucial point. A mining company only benefits from higher gold prices if it is producing enough gold to take advantage of those higher prices. It is like a bakery during a time when bread suddenly becomes more expensive. The bakery does not make more money if it cannot bake enough loaves to sell. So when do mining companies truly benefit from high gold prices? They benefit when production is rising, or at least holding steady. For example, some Canadian mines, such as Detour Lake, increased output after discovering new resources, allowing them to produce significantly more gold. In Argentina, the Veladero mine extended its operational life after new deposits were identified, which also increased the amount of gold that could be produced. In other parts of the world, companies have improved production simply through better technology. In Australia, Newcrest achieved higher recovery rates using advanced processing methods. In Peru, Yanacocha improved extraction processes and lifted its output. Production can also increase when mining companies expand their operations. Mines in countries like Mexico and the United States have added new shafts, new processing mills, or new underground areas, which allows them to move more rock and produce more gold. Sometimes the boost comes simply from richer ore. Colombia's Buritica mine is known for exceptionally high-grade rock, which means each ton of ore produces more gold, making operations far more efficient. When these kinds of positive factors line up during periods of high gold prices, mining stocks can actually outperform gold itself. This is where the so-called leverage of mining stocks finally appears. But here's the part most investors overlook. Production often goes down, and when production falls, even very high gold prices do not guarantee higher profits. Some mines decline simply because the easiest gold has already been extracted. Many long-running South African mines are producing lower-grade ore after decades of operation. Peru's well-known Yanacocha mine has also seen long-term declines in output. Other mines struggle because of technical problems. Argentina's Veladero mine experienced shutdowns following environmental incidents, and mines in Nevada and Chile have dealt with unexpected equipment failures or underground collapses that forced them to pause production. Sometimes the issue is cost. In Australia, rising energy prices have increased the cost of running heavy machinery. In Argentina, inflation and import restrictions make spare parts and equipment far more expensive, which cuts deeply into profits. Regulations and social challenges can also reduce production. Mexico recently tightened mining laws, which changed how some operations function. In Peru, community blockades have repeatedly halted mining activities for extended periods. And in certain regions, political or security risks can shut down operations entirely. Mines in Mali, Burkina Faso, and parts of Colombia have paused production due to instability and safety concerns. In all of these situations, it does not matter that gold is selling for a high price. If a company produces less gold or faces much higher costs, its profits shrink, and the stock often falls regardless of what gold is doing. The core lesson is that gold mining stocks do not simply rise because gold rises. A mining company's performance depends on how much gold it can produce, how much it costs to produce that gold, how stable and well-run its operations are, the rules and politics of the region where it operates, and of course, the geology itself, meaning how much gold is actually left in the ground. Gold can become more valuable because it is scarce in global markets, yet a mining company may still struggle because it is running out of its own supply. So the next time someone says, gold is up, so you should buy gold miners, you will know why that advice can be misleading. Mining stocks are not just gold with extra leverage. They are real businesses with real operational challenges, and they behave like businesses. If you want exposure to gold, you might choose a mix of physical gold, ETF, and then, if you understand the risks, selected mining stocks. Thanks for watching. If this helped clear up a common misunderstanding, please like, subscribe, and share it with someone who assumes mining stocks always follow gold. I'll see you in the next video.